Okay, I think we can begin. Let's. I was actually waiting for more people to join, but I'm not sure how many are going to join. So might as well let's begin. My name is Mithil Pradhan. If anybody was there in the last CMT batch, or if you're progressing from level 2 to level 3, then you would probably know me because I'm teaching for the last couple of years now. Of course, naturally, I'm a CMT and a technical analyst. I did my CMT between 2011 2013. A lot has changed after that. In terms of the curriculum and everything has changed a bit. A lot, actually, not a bit. Nowadays, we are more focused on machines and mechanical ways. And the amount of classical technical analysis has been going down structurally over a period of time. Thing is that I do classical chart analysis better because I am, let's say, a purist or a chartist who looks at only the chart without any indicators, without any as much of confirmation or breadth indicators or sentiment indicators or oscillators or any kind of derivatives of price. I only look at price, and my time frame is pretty much long term. Okay, so I play multiple cycles at the same time. Let's say, from bear market to a bull market will be one cycle, but I will play 2 or 3 cycles at the same time. So I invest for ultra long term, and I use only the chart. I do not really understand fundamentals. I do not really trust indicators. So the only thing that is left is price charts. And that is the reason in every single level, most of the time, the topics that I have chosen have to do with classical technical analysis. And I believe that classical technical analysis, with the modernization that we have and now AI that we have, most people are technical analysts today. Not many people are pure chartists or who are only looking at the price. Remember that 100 years back when technical analysis started to be born, it was only the chart and no indicators. Indicators came much, much later, but they have generally taken over. So I use a combination of peak and trough progression, which emerges from the Dow theory. I use wave theory, but not the way that most people use. I mean, I do not do much of counting, and I am only interested in the patterns of Elliott wave. And the final thing is Fibonacci, better said proportions, because I believe in the balance and proportions of the markets. I believe that everything that you need to know, you can know with the help of the chart and proportional understanding. You may not need more than that. So yeah, that's about me. I also run a company which does forex analysis for corporates, helping them to hedge, unhedge, and manage their risk with respect to dollar rupee volatility, or let's say euro volatility and things like that. So any questions? Anybody wants to say anything?
Mithil, do you trade only Indian market, Indian equities, or US also?
I do 3 countries for the time being.
Okay.
This is US and another country called Taiwan. Europe is a problem because there are a lot of withholding taxes there. Many other markets are just not investable because a lot of markets are basically just sideways from a very long period of time. I may get into Japan at some point of time, but not right now. There are no opportunities. Anyone else? Anybody giving CMT level 3 for the second time among you? Okay, no problem. Ideally, I like to keep it very interactive because otherwise it is just like speaking to the screen. So feel free if you have to ask questions. I have shared my screen, which you guys can see. Somebody can confirm, please.
Yes, Mithil, it is up.
We are going to do this particular chapter. I don't like PPTs generally. Even if you make a PPT, I'm not going to basically open it during the class. I like to take it straight away from the book. This way, what happens is I am able to mark important stuff, which you can also do yourself. Important stuff as in important statements, important lines from where questions can come in. Okay. Now, this was my style when I gave last competitive exam, which was basically the CMT. This is how I did. I used to basically take down all the important statements or keywords from a particular chapter, thinking about every which way in which a question can be asked out of me, and then basically just go on and revise the same points. It was much easier for me that way. So the focus was only on the main statements, and always imagination about what can be asked out of you. Okay, so classical chart pattern analysis. Now, ideally, you guys would have already done this in level 1, level 2. You have the curriculum has changed now, but at least you guys are coming from the previous curriculum of level 1 and level 2, in which there were chapters about bar chart patterns, which repeated, I think, in both level 1 and level 2. So more or less, you already know about most of the chart patterns. This chapter is not that very difficult, and it comes from it is built upon the previous chapter in what you studied in level 1 and level 2. In here, they are looking at entry prices, design trades by generating price objective, entry prices and protective stop loss prices using both 3% and ATR and multiple rules. Remember, this came from level 1 and level 2, where there was a chapter on breakouts, breakout stops, retracements. And in the case of breakouts, they came out with 2 or 3 different possibilities or options or alternatives that you will have in order to confirm a breakout, right? And let's go through some of the patterns also, just to refresh the memory. So in this particular chapter, if questions have to come, they can come from virtually any single pattern. In this particular chapter, they have, for the time being, used primarily the head and shoulders, but I don't think so. They will continue to use that. You will need to know about all the patterns. Okay, so you have the rectangle, which is basically 2 horizontal lines up and down, right? If this same rectangle, this is a rectangle, and this will be a continuation pattern. If it breaks out below, it will be a reversal pattern. This is what you should know. Now, the same rectangle, if it's placed a little slanting, will become a flag. Remember, flag is a continuation pattern. Okay, now, right now, we are only looking at horizontal. So what all comes in horizontal? Generally, these two. Then you have triangular patterns. So this is your symmetrical triangle. You will have one flat trend line and one upslanting trend line, which we'll call an ascending triangle. Okay, and then you will have the same angle, but absolutely inverse, which is the descending triangle. And then you will have something called as the broadening triangle. Now, generally, there is no real way of trading the broadening triangle. So, even if you can find one, it's generally of no use. Then sometimes the broadening triangle will join with the symmetrical triangle in creating a diamond top. Okay, now these are mostly using horizontal lines. There is one which uses rounding lines, which means you have the rounding bottom or the rounding top. The rounding bottom can have another small cup, which will then become a cup and handle. Again, the horizontal line comes into the picture. Mostly, most patterns have a horizontal line. There is an Adam and Eve top, not a part of your curriculum, that what most people believe to be a topping pattern, exactly inverse of the cup and handle pattern. And then the rounding patterns can further evolve. If there is a round on the left hand side, then you will have the head and shoulders. This is the inverse version. The rounding nature is because of this rounding that happens. It doesn't need to be always a rounding one. It can be a sharp one also. But as you can see, there is still some rounding happening. And then this is the Adam and Eve top, in which if you have a peak before, then it will become the head and shoulders pattern. So head and shoulders is mostly used in this pattern. What did I forget? Okay. So symmetrical triangle generally are very big. They are going to take many, many days, many, many weeks, or many, many hours, as the case may be. But if there is a small triangle, which only takes a few days to a couple of weeks, then it will become a pennant. Okay. Ideally, if they ask you a question, it is going to be the rectangle. It's going to be either of these triangles. I don't think diamond they will ask you. I don't think pennant is going to be a part of it. I don't think broadening is going to be a part of it. So these three, they can still ask you questions. Generally, the idea is very simple, that no matter what pattern is, let's say this is the pattern, then you take the width of the pattern from the peak to the trough and then add it to the breakout point to get a target, or subtract from the breakout point to get a downward target. Okay. Now this pattern can be this rectangle, or it can be, let's say, if it's the head and shoulders, then again you take the peak and the trough, and again you calculate, add it to the breakout point, get a target. If it's ascending triangle, again the breakout will happen here. So this is the width of the pattern, which you will again add to the breakout point, and same for the descending triangle. This again is going to be the width, which you will add it to the breakout point to get a downside target. If they ask you about flags, remember that flags occur in the middle. So you will calculate A to B and add to C to get your D. These are all the general patterns. Have I forgotten any? And see, I work with these patterns, okay, and especially very, very long-term patterns that the markets build over a period of time. I don't look at a pattern which is taken only a few months or a few years to build. Now, these are the general illustrations, as you may call it. You are unlikely to get a perfect pattern from the market, but most of the patterns will generally look like some of the illustrations that we have just drawn. So it requires a little bit of art to basically open up the pattern and see that, what kind of a pattern it is. Is there something that I don't understand in this pattern? Is this pattern lacking in a few situations? You have to all ask, and it is a training of the eye, which you can only do yourself. It will take a period of time, but then you will start finding great patterns. The reason I'm saying this is because breakout trading is one of the most logical ways of making money. Everything else is data mining, right? You create, okay, give me a buy signal when price is above X moving average, when RSI is so and so, stochastics is so and so, and maybe another indicator is XYZ. Okay, so as long as these four conditions are being met and I'm getting a buy signal, how does the buy signal perform? That is all okay, and these keeps on changing as the market characters keep changing, because these are all derivatives which are trying to predict the price. But when it comes to price and price alone, then breakout trading is one of the most exciting ways. I have looked at thousands and thousands of patterns. Yes, there are failures. You need tactical advantage to fight the failures. But even then, breakout trading is one of the most exciting ways of trading or investing in the market, I believe. So even though this book, so this all knowledge comes to us from Edwards and McGee, because what Dow did was Dow called any sideways action that happens he called it a line and then just, didn't pay attention to it. It was only when Edwards and McGee came, they tried to study these lines on the chart and gave it different names. That is where we get all these patterns from. And believe me, that even after about 100 years, the patterns have not changed. Edwards and McGee looked at 30, 40 years before them. They came out with their book in 1940s. And they looked at maybe many years of data to find these patterns. And so, these patterns go even before Dow himself. And these patterns seem to be there in the market, and they come up again and again and again and again. Let's move on to our book. Okay, so price objectives are basically the targets. Entry prices is the kind of filter that you're going to use to get into your breakout trade. Remember, your job, at least about 50 to 60% of breakouts fail. So that means about 40 to 50% of breakouts succeed. I mean, the numbers can differ. 60% succeed, 40% fail, and things like that. Your job as a trader is to enter at such a level which completely confirms the breakout, and yet it is not too late to enter. Okay, and protective stop loss. At what point will you actually exit this particular trade? Okay, and there are two systems that they are going to basically look at. It's the 3% filter, that after the breakout, the market has to go up 3% in order to give you an entry, and then using an average true range. Okay, calculate risk reward ratios. If an essay question comes, it will be mostly this. They will give you a trade, they will give you a pattern. You have to find the entry price, you have to find your stop loss, and you have to look at the target price. And after doing that, once you find out the stop loss and the price objective or the target, you can design the risk reward ratio or reward to risk ratio, either ways. Devise a plan to negotiate failed patterns. Okay, so here is the first line that I've marked. Identification of classical chart patterns and their price target calculations. They have already done that in level 1 and level 2. Confirming breakouts and breakdowns using the 3% rule as discussed by Edwards and McGee. Okay, so I told you there are two methods: average true range and the 3% rule that we're going to look at. Okay, so this is one nice chart pattern. It does look like perfect head and shoulders. There are multiple strikes on the left hand shoulder, as you can see. And now the price is at the neckline, trying to break out. Okay, now you don't really have to wait for a breakout to calculate the price target, because all you need to do is take the low point and take the neckline wherever you've drawn it, and this distance will be added to this distance. They have also added a 200-day moving average. Most of the pattern was built below the 200-day moving average, and now when the price is breaking the neckline, the author also feels that price is breaking above the 200-day moving average. So ideal setup, according to them, is taking breakout signals when price is above the 200-day average, and the breakdown signals when price is below the 200-day average. This aligns our trades with the trend and ensures we are trading in the same direction as the overall trend. Okay, so far, suppose an essay question comes in, then there are a few things that you should know by now. We know about the targets because that is the depth of the pattern that has been clarified. Entries are in two ways: the 3% filter and the ATR. We'll come to that. And they are including a 200-day moving average. So if you get a chart, you can say a line or two about the 200-day moving average while keeping these lines in your memory. Okay. Okay, so the neckline is here. Let's see, this is the neckline, and this is the 3% filter. So as you can see, the price has maybe broken out above the neckline, but it has not broken out above the filter yet. We want price to be here. That has not happened so far. So your entry has not triggered. Okay. They have already calculated the price target by taking the depth of the chart pattern at its widest point, remember, adding it to the neckline. So you get these numbers. I don't think you want me to go into the calculation because all of you guys would have already done that. I'm just bringing your attention to the most important points, that if you have to write an essay, these are the things that you need. So from here, I'm going to add risk reward ratio also. These are the points you need to keep in mind. Write it down somewhere. This is where this is how you will answer. Now, the second method of the ATR, 10-day ATR, and we have to adjust our protective stop loss and confirmed entry values. By doing this, we are able to calculate position size depending on the percentage difference between the breakout confirmation. So as of the close of the last bar, ATR 10 was 2.6. For the protective stop loss, we will take 0.5 into ATR. All of you guys must be understanding this. This is how even trend followers usually take ATR. They will find the ATR value. They'll find the ATR value, let's say a 10-day ATR or a 14-day ATR, whatever you're using, you will find the ATR, what it is, and then multiply it by a certain number. Okay, in this case, they have taken 0.5, but it can easily be 1 or 2 or 3 or whatever you want. The larger it is, the larger will be your stop loss. This will be a smaller stop loss. Okay, so in this particular case, remember, they have taken a 0.5 ATR. And then simply just whatever the ATR is, you multiply it with 2.6 or whatever that ATR is, 0.5 multiplied by whatever the ATR is. And protective stop loss should be placed at 0.5 multiplied by 2.6, which will be half of 2.6, 1.3. And just simply remove it. Remember to do this step also from the breakout point, from the entry price rather, sorry. So here, I made a mistake here. Entry, they are taking on 3% filter, and stop loss is based on ATR of 10 days multiplied by 0.5. So in this case, the stop loss is coming right below the entry. And it's a good stop loss, just that it is, I feel it's a little too aggressive, because in my experience, what happens is once a pattern gives a breakout, okay, it may come back. Just that you don't want it to come back below the neckline by a wide margin, okay? So if I was a trader, I would be very uncomfortable with this stop loss, because it is way near. Even if there is a hit and then a move up again, then also our stop loss will trigger. So ideally, I would like it a little deeper. I just don't want the pattern to completely come inside the pattern, because then it will possibly a failed breakout. And I will explain this to you why. See, try to understand. This was a resistance. Once the resistance is cleared, okay, the bulls have won. The bulls have taken over from the bears. This supply line was completely destroyed. Now, after destroying this line, you don't want the price to come back inside, because it has already conquered it. So ideally, price tends to remain above the breakout point in most cases. Coming back inside opens the door for a failure. Okay, and if a failure happens, then this earlier resistance was a supply line. You will feel that the bulls won temporarily, but then the market came back. So this resistance in that case stays. This was just an outlier. And then the market is going to fall all the way to the next support. Everybody, a lot of people, so the earlier position was short position because everybody was selling at all these highs. Now, as soon as the market rallied above this, shorts covered, longs built up. This is the situation that gets created. When the price comes back inside, suddenly everybody realizes, the longs realize that the breakout has failed, and shorts realize that they have just had a moment of stop loss running, stop loss gunning as it is called. And then everybody jumps into the ship to recreate the positions. The longs are exiting and the shorts are building their positions again, even more aggressively, because of which the market usually tends to fall very rapidly. You don't want to be there when a breakout fails. Okay, so now you can see that whatever the target was, it has been achieved. Market never came back inside the pattern. This is typically the characteristic of patterns that are actually going to work out. The risk in this setup equals the difference between the entry price and the protective stop loss. Okay, so all you need to create, to calculate risk reward ratios is basically the risk, and then you want the reward. So reward, you already know, this was your target, this was your entry somewhere around here, and this was your stop loss. All you need to do is calculate this against this to get your reward and risk, and that will give you a risk reward ratio. This you will have to calculate according to me. Especially for question comes, which will most likely come. There is another case study about a certain rectangle. A rectangle is a well-defined boundary with a minimum of 3 touch points. It shows the battle between buyers and sellers. So breakout or breakdown will basically start the trend period. Okay, false breakouts are a part of trading business. We'll come to that in a little while. Now they are. This is important because this line says that they are looking at an intraday breakout signal if the price trades at the filter. Okay, so this is the horizontal boundary of the pattern that we are going to look. Okay, this is the resistance. You add 3% to this resistance, and even if on an intraday basis the market goes above this, so 86.25 plus 3, which will be close to about, let's say, about 89 or 89 and a half. As soon as the price goes above that, we will get our entry. Again, the depth of the rectangle is going to give you the target price. And finally, you just have to look at the ATR 10 daily value. It is equivalent to 1.58 on the day of the breakout. Okay, this is your rectangle. You can see that the 200-day moving average is in between that, but this is what generally happens whenever prices go sideways, especially in a continuation patterns and all. Moving averages tend to fall in the middle of the range. May not necessarily be true for a 200-day moving average, because the 200-day MA is like an elephant. It moves ultra slow, and it is very, very slow in changing its direction. So may not be for 200-day, but mostly for other moving averages. Okay, so this is your resistance. This is your 3% filter. And on the day here you get triggered, you will find the ATR. And then you will multiply ATR with 0.5 as they have done in the previous case, I guess. Let's see. Yeah, see again 0.5. Hold on a minute, guys. Just one. Sorry about that. Okay, so they have again taken 0.5, as you can see. So remember this number, write it down somewhere. You just need to multiply this 0.5 with the ATR to get your stop loss, protective stop loss. And then calculate your risk reward ratio with the target and the stop loss. This is NALCO. They have taken an example of an Indian stock, apparently. So your target is reached here. There was no pullback whatsoever. As soon as the word go, the market started going up, all higher highs, as you can see, and the target has been achieved. When you aim for an early entry, we are risking getting ourselves into premature breakouts, which will eventually decrease our win percentage, may also increase the loss average. And if you are watching the markets today, you might have actually observed a lot of failed breakouts. Even on a monthly scale, a lot of breakouts have horribly failed. If you know, and when they fail, you know, remember that when you break out from a particular pattern, okay, and stay there for a day or two or a month or two, and then you start falling inside, it's basically the breakout denied. No more gains are denied. This tends to be a very, very big problem in the long term, because the breakout has been denied, so the resistance stays, and if that happens, then the stock can virtually go down really a lot. So risk management will become absolutely important, and it is not going to be easy. um, Prices tend to fall a little more sharply if a breakout has failed. If you take an, I think this is what they mean. How about applying the ATR rule to the confirmed entry? Okay, so if you take the same 0.5 multiplied by the ATR value, add it to the breakout point here, your entry will shift lower from 88.8. This 88.8 was due to the 3% filter, and this 87.4 is because the ATR filter. Now you're using the ATR to enter. Naturally speaking, you're entering a little too early, and because of which your ratio actually becomes much more better. You make 6 times the uh, money with $2 of risk, or you know um, at least double or triple of what you were earlier doing using the 3% rule. Failed patterns and how to trade them. We are again taking the example of head and shoulders. There is an old technical saying that from failed moves come fast moves in the opposite direction. Okay, now I told you that breakout trading is one of um, evidence supported trading methods where people have done good things. There is a lot of patterns which are systems which are actually built around a trade, something like Davos box or things like that. There are some traders who only trade breakouts, uh, but there is nobody stopping you from trading both the sides. You can trade successful breakouts, and you can also trade unsuccessful breakouts, okay, by going against the market. And it requires a tactic, but it can be done. Let's have a look at this pattern. This is how it looks like. The neckline is at 1.570. It's perfect rounding, shoulders almost at the same height, head in between. Though you will realize that this is not necessarily a very big pattern. What chart is this? Weekly scale, okay. So it will be a big pattern, I'm sorry, because it's a weekly scale. Okay, now this is where it is going down. This is where the neckline has been kind of broken down. I would have ideally liked a little more breakdown, but it's okay. This is your 3% filter. It has also touched the filter, but it has not gone down below that yet. And then come to this. Let's do this. They say that even a confirmed breakout can fail to reach the price objective and reverse above the neckline. This can happen. There are many alternatives that you will face when trading breakouts. Let's say if this is your pattern, the breakout is this. Now, assume your 3% filter is here, ATR filter is here. It can trigger everything, and then also it can fail. It's okay. Sometimes it will not achieve this and then fail. Sometimes it will go higher, and then because of some market turbulence, it might fail. Like for an example, if you're looking at stocks, this kind of pattern in stocks, right? Now, stocks have a lot of overhang or a lot of effect due to indices, the benchmark indices. And if suppose the benchmark indices start going south because of some major issue, then your pattern may not actually reach the target and may fail. And the fourth thing that can happen is that it can achieve the target, and then without paying any attention to the target, it can go up. Remember, the target is not a resistance. The target is just a statistical number that you have found by measuring the depth of the pattern. So when you're trading breakouts, all of these various situations can emerge, and this rabbit can continue to go up, up and up and up. And those patterns can, last for months. Even if you're looking at the daily chart, you can find a breakout that can go very, very high. So all these situations are there. And then the perfect situation that you're looking for is that the market goes up, achieves your target, and then probably goes down. And then you're very happy. But these things rarely happens. There are many alternatives that can play out with. For bearish chart patterns, price targets are calculated in percentage terms rather than dollar terms. This is very, very important. They can try to trick you with a downside breakout, and then you will go and measure your entry price, the width minus your entry price, and will get you a target on an absolute basis. This is wrong. For a downward breakout, you have to calculate the percentage. Again, very theoretical. I believe that even with the upward breakout, you might as well look at a percentage only. But from the perspective of this book, perspective of your exam, remember two things. One is upward breakout. They have been very happy calculating the absolute distance between the width and the breakout point. And then if you have a downward break, then you look at percentage. So again, you go to the depth. This is your depth. You calculate the percentage between this, and then you add it here to get your target. Now, in this case, what they have done is, you can see that our trade, if you were taking a breakout trade, it would have got activated over here at the 3% filter. But the very next candlestick has gone up. As you can see, it has given a counter attack, and it has also closed above the previous week's high. So it is looking strong. Now, there is nothing that you will do. Remember, in this example, we are trading the failed breakout. Now, we are going to wait for the market to go up. Here they have drawn a line above the right shoulder. Remember from your earlier books, when does a head and shoulders pattern get invalidated? So this was a thing that you would have studied before. Suppose if there is a head and shoulders, this line, if the market moves above this line, then the head and shoulders has failed, or you can say invalidated. So this is the same thing that they're going to use. As soon as the head and shoulders gets invalidated, they are going to go long. Similarly, when there is an inverse head and shoulders, for some reason it might have broken out and it has started falling. Now there's nothing that we can do over here based on the author, of course. I would bail out very quickly as soon as it enters the pattern, because then it becomes very dangerous. But according to the author, you will take the right shoulder low, and if the market goes below that, then this is your place where you're confirmed that the breakout has failed or the pattern has failed, and then you can open a short according to the author. As you can see, the market continues to go higher. Now, above the right shoulder also, they have taken a 3% filter or an ATR filter, as the case may be. The chart pattern negation level for head and shoulders top, negation for head and shoulders top is the highest level of the right shoulder. We'll use a 3% rule again, 3% filter, and calculate 3% above the right shoulder. A price target for the head and shoulders top failure is calculated by taking the depth of the pattern at its widest point, the difference between the high of the head and the neckline, as in this particular pattern. And given the direction of the breakout, applying absolute price movement, remember absolute, not percentage, because this is an upward breakout. The head and shoulders top failure price is 2400. So you're doing the same exercise, but then you are applying it from a different place. So you're taking the difference between the head and the neckline, and then you're adding it to the breakout point to get this particular target. Remember this. This is important, and question can come. Not that difficult. I think it's pretty easy. Generally, this is what happens when there is a failed breakout. The reaction is even much stronger because people are trapped here big time. People looked at this head and shoulders. Generally, my observation among I have been teaching for a while. Even before teaching CMT, I was teaching other technical analysis courses. Now, of course, I don't. But my sense is that initially, when somebody is learning technical analysis or learning chart reading, they only see fragments. They only see certain patterns in the market which their mind recognizes. They do not see the complete market as one single unit, and pattern as a small part of it. So because of which, no matter how good charts or how nicely long-term trending stocks that I've shown to people, they tend to get fixated on patterns that they recognize. And because of this pattern, your bias, because it is making head and shoulders, your bias is going to turn negative. You can see this across the place on Twitter or on YouTube, people analyzing patterns, they find a bearish pattern and they start becoming bearish for the stock. They forget the trend, only remember the pattern. Okay, and this is where failed breakout is going to suck you in very, very badly. Generally, you should always trade in the direction of the trend. Okay, now a few statements about subjectivity in classical chart patterns. When they say horizontal and diagonal boundaries, they are actually talking about trend lines. There are primarily two kinds of trend lines. One is slanting upward, slanting downward. The angle can be, a good angle. The angle can be steep, angle can be further steep, angle can be flattening, angle can be sideways, and this is your horizontal trend line. Okay, these are the various trend lines that you will draw. All the patterns are created by either the horizontal trend line or the slanting up or the slanting down trend line. Okay, slanting trend lines are basically trending trend lines. When your a trend line that you're drawing has a slant, the market is going somewhere either up or down. And when you're drawing horizontal, you're basically looking at sideways trends. Both these things are very, very different in a way. When it's very different rather, to be trading a trending market versus trading a sideways kind of a market or a sideways kind of a pattern. Okay. When you join two horizontal trend lines, it becomes a rectangle. When you join two upslanting and downslanting trend lines, it becomes a symmetrical triangle. When you join one horizontal, one slanting, they become ascending or descending triangles. Okay, so trend lines are important because they will allow you to basically open up the pattern, understand the pattern, what exactly is the pattern that is being formed. So technical analysis is considered to be an art or a craft. Why? Because simply if you follow the rules written in various different books, you may or may not actually succeed. Okay, because there are many other things that come into the picture, especially when it comes to classical chart analysis. In classical chart analysis, one analyst is very different than the other analyst because there are patterns. You have to understand the pattern. Some people may look at a pattern in a certain way, the other may look in a very different way. Okay, so some amount of subjectivity is definitely involved, and it is also a level of skill. I read patterns much more better today than I did 5 years back. I read patterns way better than what I did 10 years back. I see more. I see 100 times more than I used to see about 10 or 15 years back. So subjectivity is going to be a part of chart reading. In fact, a lot of people look at price patterns, and a lot of them are flowing on Twitter, um, but not necessarily that me being a similar kind of a chart reader, I may not be actually looking at that pattern in the same way that influencer is looking at. So what the market is telling us, that is what charts see. Not necessarily, because everybody thinks technical analysis is very, very predictive in nature. It doesn't need to be predictive. You don't need to predict anything. Technical analysis shows the things that the way they are, and it is again not always. It's only a few times when you can, using technical analysis or chart reading, only a few times that you can actually say that what is more likely to happen. All the time, it is not possible. Every day, not possible. Most importantly, traders don't leave their biases aside. And these biases get imprinted by 100 different things that are going around us, the news and the social media, people saying, fund managers saying things. We start wondering if a certain fund manager is saying so and so, then really the market is in trouble or the market is doing well, or whichever way. Simplify your analysis to an extent that a 5-year-old would understand. In classical charting, simplicity comes by using a pencil and a ruler, like they used to do it in the olden times, to focus purely on price action. Many students start initially drawing diagonal lines. Diagonal, the author has correctly said that they are easier to draw, yet they might be least reliable, because you will need a different set of skills to be trading diagonal trend lines. They need constant adjustments. A good trade setup is a rare occurrence, and it is absolutely true. Think about this, that there are 4,000 stocks possibly in the Indian markets listed. And I trade all the kind of stocks. Mostly all of my stocks are small caps. even micro caps many a times. And out of these 4,000 stocks, my list is barely about 100 stocks. This is all that I could find. Just 2.5% of the entire market. 2.5% of the entire market have good setups according to my method. Your method may be different, but then the rarer you get opportunities, the better it is. We need to scroll through hundreds of charts to find one excellent chart pattern. Very well said. There's no better way of saying that. Focus on horizontal boundaries initially. It will improve your objectivity. And there is a reason for that. See, try to understand. The market has a cycle, continuous cycle going on, which is called the trend range cycle. This is not a part of your curriculum. This is not how they have designed it. So there will be a trend, then there will be a range. Then there will be a trend, then there will be a range. Then there will be a trend, then there will be a range. It doesn't happen as statically the way I'm telling you. There is no time period for saying when a trend or when a range is going to begin. But naturally speaking, anything that is in horizontal boundaries is something like this. So this is a range. So after a range, a trend will begin up or down, either ways. All you have to do is just figure out the right way of catching this trend. The trend is almost guaranteed. In most of the cases, you will get the trend. It will be a starting point for a big trend. You can see the trend, range, trend, range. This is trend, range, trend, range, trend, range. Maybe a trend. Difficulties of trend line identification. What is the real trend line when it comes to even horizontal setups? But horizontal setups are generally easier. The more difficult are upslanting or downslanting lines, because what is the real trend line you don't really know. And even if you figure out the right trend line, then also there is a problem, because the market can virtually break your trend line and then again continue in the same direction it was continuing before, just by changing its angle of the trend line. It can do that. You also don't know which one is the most important trend line. So my sense is the author here is absolutely spot on. Initially, if you're new to technical analysis, if you're under 5 years, you're actually new to technical analysis, then focus more on sideways patterns. Here we're talking about simplicity, well-defined, simple horizontal setups. This type of price action is orderly in the sea of randomness. Our job as technical analysts and chartists is to find order in randomness. This is because from these orderly price actions emerge predictable directional movements. If one can repeatedly focus on identifying consolidation areas that are bound by horizontal boundaries that have been tested several times, the number of quality trading signals may actually increase significantly. No doubt about that. Okay. The human brain is limited when it comes to identification of so many classical chart patterns. It's not limited, frankly. And there is nothing wrong with our visual capabilities. All it takes is practice, 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 practice. If you go through 1,000, 2,000 different patterns, your mind will build up the capability to figure out how to trade patterns. I'm telling you from my own experience that we are not limited. It's just an understanding. Nobody can tell you this understanding. You have to figure it out yourself if you're going to get into patterns in that case. Volume dries up as the pattern continues. Remember this point also. You may have to write something in the essay. Chart patterns are repetitive and timeless. Repetitive does not mean that a similar kind of rectangle is going to come again and again and again and again. It's not. There is always going to be a little change between one rectangle and another rectangle, yet they will fall in the category of rectangles. Many a times you may not actually have to find which pattern it is. It is only from the perspective of this exam. But frankly speaking, most of the sideways patterns have a horizontal top or a horizontal bottom. And then rest of the thing is sideways. Whether it is creating a pattern or not, we don't care. We just care about this horizontal line, the resistance that the market has to break out above. Whether it's a cup and handle, whether it's a ascending, descending triangle, it does not really matter. And there are patterns which will fulfill that illustration which I've just drawn, and yet there are no names of those patterns. Okay, last statement of this class also, actually. In artificial intelligence, if you feed artificial intelligence with what you're exactly looking for, see, so far algorithms were not able to find patterns because, even if you say that, even if a particular software has to find rectangles and by drawing automatic trend lines and things like that, even then the software was making way too many mistakes. Till now, that capability was not there. You can create a neural network system from computers, but you cannot make computers read price action because it just doesn't know what to do. AI might be able to do something, I'm not sure yet, but I feel that it is possible if you feed the AI with the right amount of variations. Like if I can give an AI variations of the rectangle, let's say 10 variations, 20 variations, maybe AI will be able to find this in patterns. We don't know, but till today, as of today, I think humans are best equipped to study and find patterns than computers. That's about it. This is something that we are going to do tomorrow, candlesticks. Again, not a very difficult chapter. I think it's a good question. I think what they feel is that suppose the neckline is at $10. Okay, let's say there is a pattern. Let's say a descending triangle. Yes, the neckline or the support is at $10 for an example. The width is $20 from peak to bottom. Let's say the peak was at $30 and the width is $20. Now, if you remove $20 from 10, then what? The stock cannot go to minus 10. But if you look at this decline would be of, let's say, 70%. Then you can remove 70% from $10 to reach a target of 3. Hence, it is done on a percentage basis. I think so. Okay, guys. Any other questions? We are done with this chapter. Pretty early today. Any questions? Yeah, again, Karthik, this is not something that they have defined in their books. If you look at the irony of it, usually they have looked at patterns that have lasted a few weeks to maybe, let's say about 6 months or 9 months or things like that. They have not really looked at long-term patterns. But I look at long-term patterns using monthly charts. So I always use percentages because once you go long-term on weekly and monthly charts, then the value of absolute price movement is just not there. There is no value. You have to use log charts. There is no other alternative. My charts are by default log. I also believe that market is exponential and market is more percentage based than it is point based. Again, my opinion. So it's always a log calculation for me. I cannot exactly show it to you. I don't like to, nobody would like to disclose their strategy, but I will still answer your question. I do not have any targets, generally speaking. So once the trend begins, I will trail it. Yeah, you correctly asked, exit, or I will book it, let's say, a little at every single interval. So suppose it again depends. I have a stock which went up, let's say 10x for an example, and I did not book a single point of worth of position, and the stock has then come down 40% from there. So it's still up about 6-7x. But then, since I'm playing multiple cycles, because of the strength of the pattern, I am going to wait a few years before even starting to look. It's all arbitrary because targets are something which are not. Targets are guesstimates, if you ask me. It's very difficult to exit the market. You have a lot of evidence when you're entering a particular stock, but usually when you are exiting a stock, there is not really much evidence. Okay, targets don't work the way they talk about in technical analysis books. Many times targets are overshooted also, and they give much higher risk rewards than what our technical books tell us. So I let it flow to a certain extent, and then I will book a little here and there. Generally, whatever I buy for many years. So suppose a stock goes 10x in 2 years, then I know that it has moved way too early, and I may wait another cycle, the next bull market, for it to really go up that much. Again, it's all trial and error. No, not much big drawdowns. Not really. I don't have broken stocks in my portfolio. And I believe that 30, 40, 50% kind of corrections do happen every 2-3 years. So I'm always prepared for all those things. In fact, I look forward to it. Corrections is when I build my positions. Again, not something that I would recommend anybody. It's very dangerous. But I love corrections. If they occur at least once in 2 to 3 years, I'll be very, very happy. It is painful. Your portfolio is going down. The pain is good, according to me. Okay, anybody else? Any questions? Current situation is a bear market. A welcome one. I'm building my positions for the next bull market. I don't know how much the market will fall, whether the market is already bottomed out. I can't tell you all these things. Nobody can, actually. It's not possible. And market is not something that I actively trade. I trade only stocks. So, this is something that happens every couple of years. This is not an outstanding situation. It happened in 2022. It happened in 2020. It happened in 15, 16. I'm talking about of approximately 20% plus in the Nifty. So this happened in 2024. Almost Nifty must be down 17-18% at some point of time. It already is near 52-week low, if I'm not wrong. Almost we must have fallen about 20-odd%. That happened in 2022. That happened in 2020. It happened in 15, 16. It happened in 10, 11. It happened in 2008, 2006, 2004, 2001, 2000, and many times in the 90s. So this is not something that is outstanding in nature. This happens every few years. Okay, guys. I assume no questions, so I'm going to let you go, and I'll see you tomorrow, 10 a.m. actually. So see you guys. Thank you.